Look at the markets right now. Gold, silver, the S&P 500, and Bitcoin are all hitting all-time highs simultaneously. Over the last century, a synchronized peak across all these hard asset classes has only happened twice. We are currently living through the third. This creates a psychological trap. If you invest today, you fear buying at the absolute top. But if you hold your money in a savings account waiting for a crash, inflation quietly erodes your purchasing power. This chart shows the divergence of 2026. While cash decays, assets representing stocks, gold, and crypto are spiking in unison. Waiting for a dip becomes a losing strategy when every new entry point is higher than the last. To navigate this, we are going to construct a portfolio structured specifically for these peak conditions. Whether you are starting with 1,000 or 1 million, the mechanics of protecting and growing your capital remain the same. When inflation is high and assets are peaking, holding cash exposes you to a steady, predictable loss. In this environment, doing nothing is the high-risk choice. Before looking for new gains, you have to stop the leakage. Billions are currently sitting in unclaimed deposits, forgotten Provident Fund accounts, abandoned insurance policies, and recurring unused subscriptions. You may be losing significant capital before you even enter the market. Once you plug those leaks, you need a liquid buffer. However, leaving 6 months of expenses in a standard savings account is a guaranteed way to lose purchasing power over time. Instead, use a liquid fund. These are mutual funds that invest in very short-term, low-risk debt, like government treasury bills that mature in under 91 days. They offer higher yields than savings accounts, while remaining almost as accessible. The real advantage is tax deferral. Traditional fixed deposits are taxed yearly, stunting capital growth. With a liquid fund, you only pay tax upon withdrawal, allowing your money to compound uninterrupted for years. Sealing financial leaks and moving your emergency cash into a tax-efficient liquid base is the mandatory first step. You cannot build a growth engine on a foundation that is leaking capital. Now we move to equities, the growth engine. This is the choice between active managers, people you pay to pick stocks, and passive systems, which simply track the market. The data is clear. Roughly 75% of active large-cap fund managers fail to beat the basic market index. Most investors are paying high management fees for a strategy that statistically underperforms. A passive index fund is the more consistent alternative. An index fund is a robotic system that buys the top companies in a market, like the Sensex 30 in India or the S&P 500 in the US. By removing the expensive human manager, you eliminate the single biggest drag on your returns. This gap is the cost of regular mutual funds. Agent commissions silently drain returns, compounding into massive wealth loss. Direct plans keep that money yours. While ETFs seem cheap, they hide a bid-ask spread, a price gap manipulated by middlemen, forcing you to overpay. Long-term wealth accumulation is a game of subtraction. By stripping away every layer of management fees, commissions, and transaction friction, you keep the maximum amount of market growth for yourself. Next, you need armor. Gold acts as a geopolitical hedge, an insurance policy that holds its value when localized economies or currencies collapse, because its price is set by global demand. Buying physical gold creates an immediate deficit. Between the GST and making charges, your investment often starts 5 to 10% below its actual market value. Frictionless alternatives like digital gold, sovereign gold bonds, or gold mutual funds allow you to track the price without the costs of physical storage, security, or purchase taxes. Finally, we have wildcards like crypto and REITs. A REIT, or Real Estate Investment Trust, is a company that owns and operates income-producing real estate. Buying a share of a REIT gives you fractional ownership of commercial properties and a share of the rental income. These assets provide specialized armor and leverage for your portfolio. They are not the foundation, but they are the tools you need to survive sudden market shocks. If you were starting from zero today, here is the exact sequence to build a resilient portfolio in this peak market. Step 1 is the immediate liquidation of high-interest debt. If you are carrying credit card debt at 30% interest, no market investment can reliably outpace that cost. Clear your debt first, even if it means borrowing from family at a lower rate to settle the balance. Step 2. Set up a step-up SIP. An SIP, or systematic investment plan, automates your monthly investing. By increasing that amount by a set percentage each year, your contributions rise as your salary grows, helping your portfolio keep pace with the rising costs of living. To handle the fear of buying at a peak, use the 25-75 rule. Deploy 25% of your capital immediately. Divide the remaining 75% into equal installments over the next year to buy units at lower prices. Your target allocation stabilizes at 60% index funds, 20% debt, 10% gold, and 10% emerging assets. Success in 2026 relies on automated discipline, not market timing. By removing fees and automating your growth, you let time do the work. The most effective day to start is today.